I just got approved for my mortgage. Nice, but how do you afford that? I thought you were broke. My bank finally approved me. Yeah, but how are you gonna pay $500,000 approved? Here's the reality. Just because your banker qualifies you for a mortgage doesn't mean that you can afford it. Your banker is in the business of selling loans. They're not in the business of making sure that you can actually afford your loan. As soon as you sign the paperwork, your banker gets paid and they're done, but now you're on the hook for your mortgage. Plus, what most banks do is as soon as they issue the loan, they're gonna take that loan, package it up with a whole bunch of other loans that they issue, and then sell it to a different bank. That way it's no longer your bank's problem. It's somebody else's problem if you don't pay. And just so we're on the same page, when I say afford your home, what I mean is that your income from your job or your business is enough to pay for all of your housing costs, which include your mortgage payment, your property tax, your property insurance, your upgrades on your home, and your maintenance, and you still have money left over to eat. You still have money left over to save, and you still have money left over to invest. And the reason why this is so important is because the majority of people buying a home today don't. So if you're thinking about buying a home or if you own a home, I want you to avoid this financial mistake by understanding 3 things. And I'm gonna start by talking about number 1, understanding your finances. As a financially educated person, your goal should be to build wealth, not to own a home, because your wealth can help buy you many homes. And in order for that to work, you have to have a system of knowing how to spend your money. What every wealthy person does is they know that when they make $1, how much of this dollar can be spent, how much of this dollar has to be invested, and how much of this dollar can be saved. And a simple way to do this is to follow something like my 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, when you do this, every time you get paid, whether it's $1 or $100,000, you're always saving some money, investing some money, and then spending some. Now, the reason why I'm bringing up this financial system as we're talking about how to own a home the right way is because your home is an expense. Your housing costs are expenses, which means they have to fit right here within your budget, which means all the housing costs that I just showed you, your mortgage, your property taxes, your insurance, your upgrades, and your maintenance, all of these things have to fit here and still have money left over to pay for your food, to pay for your cars, to pay for your vacations, and all the other expenses. And you still have money left over to invest, and you still have money left over to save. Now, I already know what you're thinking as I say this, because every time I say this, I get the same comments. You say, well, Jaspreet, I'm already struggling as it is. How in the world do you expect me to live off with just 75% of every dollar that I earn? Here's the reality. If you want to build wealth, because the whole goal of my financial education is for you to build wealth. If you want to build wealth, the way that you do that is you make money, you don't spend all of your money, and you have money to invest. That's how wealth is built. You have to own investments, you have to own assets. Every single wealthy person in the world is wealthy because they own assets and not because they make a lot of money from the job. So now, if you want to become wealthy, that means you have to own assets. And if you want to own assets, you need money in order to do that. And if you need money in order to own assets, you can't spend all your money on your mortgage. So you got to make that decision now. What's more important to you? Is it a big home or is it owning your investments? I'll let you decide. And this brings me to point number 2, which is that your home is an expense, not an investment. The mistake that so many people make is they assume that if I'm making a mortgage payment, I am building equity. So this money that I'm paying into my mortgage is part of my investments. And that is a huge, huge, huge lie. Did I say it's huge? As somebody who's been investing in real estate for more than a decade now, what I can tell you is that home prices go up and home prices go down. Rental prices go up, and yes, rental prices go down as well. No wealthy person, truly wealthy person in the history of mankind has talked about how I became wealthy because I bought a home and then I paid it off. They talk about how I became wealthy because I invested my money into stocks. I invested my money into rental properties. I invested my money into my business. I invested my money into other businesses. That's where wealth is built. Not through just owning a home. Now, owning a home is not a bad thing, but you have to understand that owning your home is not an investment. Owning your home is an expense. And I understand that creates a lot of emotion and a lot of controversy. And I get this because I am also a licensed realtor. I don't work as one anymore. But as a licensed realtor and as a banker, what are you told? You're told that these homes that your clients are buying, it is the biggest investment of their life. And guess what? If it's the biggest investment of your life, it's a little bit easier to buy a little bit bigger, a little bit nicer, because if you can pay it off, you can pass it down to the next generation and build this generational wealth through home ownership. But what it actually does is it signs a bigger commission check to people like me, your realtor or your banker. And then you are left with the mortgage payments. And if you can't make the mortgage payments, well, now you are sacrificing your investments. That way you have more money in order to pay your mortgage. You're also sacrificing your savings. That way you have more money to pay your mortgage, which is what ends up happening to so many people is they have this big home, but no real wealth. And now you might say, well, Jaspreet, at least I'm building equity into my home, because every time I make a mortgage payment, I'm paying off some of my mortgage and I'm building this freedom through my equity. But the reality here is, if you get a 30-year fixed rate mortgage, banks front load your mortgages. What that means is for the first 14 years of your mortgage, more than half of your mortgage payment is going to go directly into your banker's pockets with interest. And if you don't believe me, I'll show you. If you get a $500,000 mortgage for 30 years at a 7% interest rate in year one, you're going to pay $40,000 in mortgage payments. And out of that $40,000, about $5,000 are going to go to pay off your principal, just $5,079, versus the other $34,839 that you pay are going directly into your banker's pockets with interest. It isn't until year 21 of your mortgage that more than half of your mortgage payments are going to pay off equity as opposed to going into banker's pockets with interest. By the way, for all of you money nerds out there that like to keep up with what's happening in the housing market, my team at Briefs Media publishes a free newsletter called Market Briefs, which is a report on what's happening in the economy, things like housing, stocks, crypto, the global economy, and our own economy, into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. This is why I want you to treat your housing payments like an expense instead of like an investment, because the bigger home is making your realtor richer and it's making your banker richer, but it's an expense for you. Again, I'm not against you buying a nice home. I'm not against you buying a luxury home. I want you to own a big, grand, beautiful mansion. I just want you to be able to afford it first, because so many people are going deep into debt to buy these big, grand homes thinking that it's an investment for them, but it's really an investment for their bank that's making the banker richer instead of you. And this brings me to the third thing that I want you to understand is how you know if you can afford to buy a home. If you really want to be able to afford the home that you're purchasing, there are three things that you have to afford. Number one is you have to afford your monthly payment. Number two is you got to afford your down payment. And number three is you got to afford your move-in costs. When it comes to your monthly payment, this goes back to what we were just talking about a minute ago, that you have money to pay for all of your housing costs, you still have money to eat, you still have money to invest, and you still have money to save. Now, some banks follow different types of rules. Some banks will say that your housing payments cannot be more than a third of your take-home pay. Some banks will look at a 28% factor. What I like to look at is just making sure that at the very least, I still have my money to invest. I still have my money to save. And now I can adjust my expenses, my spending type of money the way that I want. Because if I want to live in a bigger home and have smaller cars, fine. If I want bigger cars and smaller home, fine. Just make sure I can fund all of my spending and all of my expenses within the spending part of my portfolio, within the spending part of my budget. Which brings me to number two, the down payment. Now, I understand it's very popular, especially nowadays when home prices are a whole lot higher, to look for alternatives to paying high down payments. But the reality is, when you look for lower down payments, whether it's 10%, 5%, 3%, or 0%, you have a couple risks that happen. Number one, obviously, when you have less of a down payment, you have less skin in the game. Number two is when you have less down payment, you also have other fees, which could include things like PMI, which could include things like higher mortgage rates. Because as a bank, when they lend you money, it is an investment for the bank. And when you have less skin in the game, you are a bigger risk for the bank. And when the bank is taking a bigger risk, they need a bigger return from you. And so when they want a bigger return from you, they charge you other fees like PMI, or they charge you higher interest rates. Versus if you can come to the table with a bigger down payment, which is why I like to see a minimum of a 20% down payment, if not 25%, but ideally a minimum 20% down payment. Now you can avoid the fees like PMI, you can avoid the higher interest rates, and now get the best rates for you. And I get it, that's a lot more expensive. It takes a lot more work. But when you buy a home, your goal is to build equity in the home as it is. And if you're building equity through the bank's money, well, now you got to pay that money back plus interest. When you pay the down payment, you're building the same equity, you're just buying it without the interest. And number three are the move-in costs. Now, what I mean by move-in costs here is, number one, if you're going to get movers to move your furniture from one home to the other, that's expensive. Make sure you factor that in. Make sure you factor in your closing costs. And number 3, if you buy a home, what ends up happening to a lot of people is you walk through and you say, oh my God, this living room is so amazing. I can't wait to buy a brand new sofa. I can't wait to upgrade the kitchen. I can't wait to finish the basement. All these things cost a lot of money. And if you haven't budgeted for them, what a lot of people do is they put this money on their credit card, they get a home equity line of credit, they get some other form of revolving financing, and now you go into debt to pay for this moving cost. I don't want you to do that. Plan for it. Know what your costs are going to be. Plan for the moving costs, plan for the upgrades, plan for whatever furniture you need, and put that money aside and budget for that ahead of time. That way you don't have to go into debt, because I recently bought a sofa. I talked about this in one of my recent videos. It was expensive. And when I was purchasing the sofa, the sales manager was very aggressively trying to sell me financing on this sofa, which I didn't want. And when I started to see how kind of it was normalized to sell this financing, I asked the sales manager, how often do people buy this financing for furniture? And she says that pretty much everybody that I sell furniture to buys financing from me. So I want you to stop doing what everybody else does. Plan ahead, budget, and save that money ahead of time. And you're going to say, well, Jaspreet, I don't have the money to buy that sofa right now. Well, here's the thing. When you finance it, you still have to pay the money for it, right? The question is, are you going to pay for it now, or are you going to pay for it later plus interest? I'd rather you pay for it now without the interest. And that might mean you don't buy that sofa now. That might mean you buy a used sofa now. That might mean you don't buy as nice of a sofa now. But at least you can afford it. Because when you finance something, you still have to pay for it. In fact, you have to pay more for it because you got to pay for it plus interest. But when you pay for it with cash, well, now you get to keep more money in your pocket. That way you have more money to build wealth instead of building the wealth of your banker and the salespeople. Most poor people and middle class people are working to buy nice things so you look like you're rich. What the real rich are doing is they want to have so much money that they can go and buy the nice things and not have to worry about the price, because it is their assets that are buying it for them. But you have to really know how this playbook works. So let me break this down with an example from somebody that I know personally.